Hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And this is October 12th, 2024, and we're talking about Texas Roadhouse. Yeah, y'all come and buy the stock, you hear? But just hold on for a minute. Even though it's been acting so good, we have to take a look at those charts. So Texas Roadhouse. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's look at Texas Roadhouse a little bit. And it operates three moderately priced full-service restaurant chains: Longhorn Steakhouse, Outback Steakhouse, and Applebee's. Now, the standout with this company is traffic, as customer count has increased for 5 consecutive quarters. And it offers an assortment of specialty seasoned and aged steaks, hand-cut daily on the premises, and cooked to order, I would hope so. And the chain offers ribs, fish, chicken, vegetables, and had 709 restaurants, 49 states, and 10 foreign countries, including 566 company-owned and 95 franchise locations operated under the Texas Roadhouse banner. Operates 41 Bubba's, 33 sports bars, and 7 Jaggers. And folks, I don't know what Jaggers is. Employs 82,000 people, so it's a pretty big operation. All right, now let's look at how the statistics compare with the average stock out there. The average stock out there is in blue, and Texas Roadhouse is in green. Now, when we went over this stock about 6 months ago, we've had some serious nice increases in the 5-year averages. These are 5-year averages, so it takes a lot to move a 5-year average. The clean surplus return on equity for the average stock is about 13.5%. Now, for Texas Roadhouse 6 months ago, it was 26%, and now today it's 28.2%. So it has gone up where the average stock has not. Now, what about net income? Net income are the clean surplus earnings. So you take traditional accounting earnings and you subtract out all non-recurring items and future liabilities, including those stock options that are used for payments, which are not recorded unless you look in the footnotes. And so we've gone from the net income of 15.1% per year on over 5-year average to 19.1%. Big jump. In other words, they are operating more efficiently than they were just 6 months ago. Now, the revenue has gone from 15.5 to 15.7. Average stock averages about 7%, 7.1%. So Texas Roadhouse is more than doubling the average stock out there, and that revenue is rising. But here's what I want to show you. 15.5% revenue translated into 15.1% total bottom line earnings or net income. Now, just a slight increase in revenue raised that net income from 15.1% to 19.1%. So 0.2 of an increase in revenue brought a lot of money to the bottom line. So in other words, this company is operating on all 8 cylinders, folks, because as it increases the revenue, the net income or the earnings really jump, and guess what drives the stock? Yeah, those earnings right there, folks. Let's look at these numbers a little closer now, and let's look at the net income. Again, net income of the clean surplus earnings. So for 2024, this number, last time we showed it, was $5.35, and now for this year, projected for this entire year, up a whole dollar. That's about 13-14% increase over the last 6 months projections. That's an amazing jump in there. And then this $6.90 was projected to be $6.15 just 6 months ago. So these numbers, this year's income and next year's income, have both grown substantially. Gives us a nice clean surplus return on equity of, we're looking at an average of 29, almost 30% in here over these 2 years. Very nice. Now, the only thing that we don't care for is the retention rate, about 60% in here. What does that mean? How much of the money is that it makes and putting it back into itself in order to grow? We'd like to see 100%. Boy, boy, like Chipotle is one of those stocks that are up there, but this is a nice retention rate. We wish they were building more, but evidently they've got their act together. In fact, they do have their act together. Now, net income growth has been averaging 19.1%. That's phenomenal. And you're looking at 2025, a growth of only 8.7%. But this year, it's grown almost 40%. So if you take these two averages, you're looking at about 49% growth. So you're looking at a growth over 2 years of about 24, almost 25% per year over these 2 years. That's a big jump. The market just loves that. And of course, revenue growth, growing the average stock 7.1%. This is up 18.2% for this year. Phenomenal growth rate. Slowing down for next year, but when you take these two and average them out, now you're looking at about a 13-14%, double the average stock out there. So that's what we like to see. Oh, and look over here. Look what I forgot to tell you about. Doesn't have any debt. Now, I kind of like investing in companies that don't have any debt, because if interest rates go up, it takes a lot of money to pay off that increase in the interest rates of the debt. And here you don't have debt. We don't even have to worry about that. Now, let's look at 1 year. Black line is the S&P 500, and back in here is right around where we said this stock is a buy, and we showed a chart saying, hey, it was making X amount of dollars several years ago, and if it was going to repeat those earnings, it should be a much higher price. And look at this. 1 year up 80%. Absolutely amazing. That's almost 2.5, almost 3 times that of the average stock, the S&P 500. Let's call it 2.5 times. So that's a very, very nice move. And since we last talked about it, this stock has just blown away all the other companies out there, all the other food companies. Now, let's look at 5 years. Black line is the S&P 500, up almost 100%. This stock is up 250%. Very, very nice, 2.5 times that of the average stock. And I wanted to show you something. And this was 2002, right in here. And it's when the market was down 20%. But the NASDAQ was down 34%, so it was a tough year. And we can see that Texas Roadhouse started declining in their earnings about 6, 7, 8 months before the market did. And I'm wondering if that isn't some indicator maybe we should be looking at in the future to see what happens with this stock relative to the overall market. Then as the overall market, again, black line, was about halfway through the year, this stock started taking off again. So this is something that we want to keep an eye on. We're not sure if this has any meaning for the future, but we still kind of have to watch that traffic falling off in a restaurant or a group of restaurants like Texas Roadhouse might give us a warning that the economy is getting ready to begin slowing down, which it did in 2022. Now, let's look at the past 5 years and compare Texas Roadhouse. Again, black line's the S&P 500. Texas Roadhouse is this mustard-colored line here. This blue line is Chipotle. And guess what, folks? Chipotle is already in our growth portfolio. So, yeah, we like it very, very much. And here's Texas Roadhouse going right along with it. Now, what are these stocks that are underperforming the S&P 500? Well, the yellow one is McDonald's right in here. It's about half as much, or returned half as much in 5 years as the S&P 500. Then even below that, we have Starbucks and we have Yum Brands. So Starbucks has been having its problems. Yum Brands, remember several years ago, it was supposed to be so good because it had a lot of places in China, think Kentucky Fried Chicken or KFC as you call it. But anyway, those stocks that have been in everybody's portfolio except ours underperforming the S&P by about half. Oh my gosh. And which stocks do we have in our portfolio? Well, we have Chipotle and we're going to have Texas Roadhouse. But the thing is that let's look at something here. This is a shorter term chart of Texas Roadhouse, and we can see this nice, beautiful rise up, and now all of a sudden it seems to have been stalled out in here. And we have this indicator up here making a lower high while the stock was making a higher high. So no matter how you look at this, we're making a higher high in the stock, but a lower high in this indicator up here. And what about down here? This intermediate term indicator is sharply turning down. So even though you want to go out and buy this stock, today is probably not the day to do it. Of course, you're probably reading this on a Saturday, so the stock market's closed. But we don't like this topping in here. This is the 20-day moving average. I would wait for this stock to settle out and reach some kind of bottom in here. So like down here, when it became really oversold, that was a time to buy this nice rally. So I would wait a little bit. But boy, oh boy, this stock is really a nice stock. We like it very, very much. Okay, folks, we've had a week in which the market reached a new high and is testing that new high, and the breadth of the market has fallen off a bit, so we want to be a little cautious in here. We have some accounts that we're selling covered calls on, other accounts we have hedges on, so we're waiting to see. And we will just go out and clear our minds and forget about the market. So remember, if you want to walk on this beach like Jimmy Buffett once did, or sit on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. So folks, go out, have a great weekend, stay safe, and we'll see you back here in a couple of days.